This is an analysis from Alpha Business Media. All right, I want you to just picture this for a second. We're in the middle of Kathmandu,
Okay.
specifically the Isan market. If you've ever been, you know exactly what I'm talking
Oh,
about.
yeah. It's a total sensory overload.
In the best way, right. You've got the smell of spices.
Cumin, turmeric, chili, just hanging in the air.
Exactly. And the sound, the rickshaw bells, the shouting, the sheer number of people, it feels, ancient.
It feels like commerce has been done that exact same way for, what, centuries?
For centuries. Now imagine walking up to a vegetable vendor. He's on a mat, surrounded by spinach, radishes, all of it.
Right.
You pick out your vegetables. And maybe 10, even 5 years ago, this is where you'd pull out a crumpled roll of rupee notes.
With physical analog exchange.
Yeah.
Handing over cash, getting change back.
But today, that whole scene is different. You pull out your smartphone.
And the vendor points to a little laminated card, a QR code.
You scan it, type in the amount, you hear that sharp beep, and you just show him the green check mark on your screen and walk away.
It's clean.
Mhm.
It's efficient. It feels like the future has finally arrived.
It really does. It feels like this leapfrog straight into the digital age. But here's the twist, and it's a massive one. That little beep, that symbol of progress, according to the deep dive we're covering today, that sound is actually the sound of a huge economic paradox.
A paradox that is quietly draining the government's ability to even function.
We're digging into a piece of research called Digitization, the missing link in Nepal's economic reform. And its core argument is going to sound completely backwards to anyone who follows tech.
It's totally counterintuitive.
It argues that the very tools we celebrate, the QR codes, mobile wallets, instant transfers, are simultaneously creating a vast, untaxable shadow economy.
And we're not talking about, illicit deals in back alleys. We're talking about everyday, legitimate commerce.
We're talking about buying spinach.
Exactly. The source says we have this 21st century digital transaction reality just smashing up against the 20th century analog tax bureaucracy. And that collision is costing the state billions.
The numbers are, frankly, eye-watering. The report says in the fiscal year 2020-2023, QR code transactions alone hit 2.1 trillion Nepali rupees.
Which was a 300% jump from the year before.
Yeah.
The adoption curve is basically a vertical line.
2.1 trillion. That is a staggering amount of money just moving through the airwaves.
It's huge. And here's a setup for our discussion today. The central bank loves this, right? It's financial inclusion. The tech companies love it. They get volume.
But the Inland Revenue Department, the tax man, is basically sitting in a dark room, completely blind to what's happening.
The source has this fantastic metaphor. They say the tax department is bringing a bow and arrow to a drone fight.
That's a perfect image, a digital target moving at the speed of light, and you're trying to hit it with paper forms.
And physical audits. It's impossible.
So our mission today is to figure out how something so transparent, something like a digital payment, creates something so opaque. And you'll want to stick around because the solution the source proposes sounds like science fiction.
But they argue it might be the only way to save the country's fiscal future. We're going to be talking about a central bank digital currency.
And not just as some cool tech fad.
No, they see it as the new plumbing required to save the entire tax base.
Okay, so let's unpack this QR code paradox, because my first thought, and I'm sure for a lot of you listening, is, wait a minute.
Right.
If I pay digitally, there's a record. It's on my phone, it's on the vendor's phone, it's on a bank server, it is traceable. So how on earth is this creating a shadow economy?
You'd think it would make it easier to tax, wouldn't you?
Exactly.
But it creates a shadow economy because of what the source calls the obfuscation of economic identity.
Obfuscation of economic identity. Okay, that sounds like a spy movie title. Break that down for us.
It sounds complicated, but the mechanism is actually really simple. Just think about how a banking system classifies a transaction.
Okay.
In a formal taxable economy, when you pay a registered business, say you swiped your card at a big supermarket, that transaction is tagged in the system as C2B.
Customer to business.
Customer to business. And that B tag is crucial. It acts like a little flare. It tells the system, hey, this is revenue, this is taxable income.
It goes on the official ledger.
It does. But now let's go back to our vegetable vendor, or maybe that small shop where you bought something last week. When you scan their QR code, what usually pops up on your phone?
It's just a name, right? Like
Okay.
Sunil Sharma. Not a company.
Exactly.
Yeah.
And that is the absolute key. Even though it's a commercial transaction, you're buying goods, they're selling goods, the banking system sees it as P2P.
Person to person.
Person to person. So structurally, The bank's computer cannot tell the difference between you buying spinach and you paying me back for lunch.
So it's hiding in plain sight.
Precisely. To the payment provider, it's just a value transfer between two individuals.
Yeah.
There's no flag that says business income. As far as the algorithm is concerned, it's just friends moving money around.
It's a commercial transaction wearing the mask of a personal transfer.
And because the Inland Revenue Department, the IRD, can't distinguish between a birthday gift of 500 rupees and a vegetable sale of 500 rupees, it all just becomes invisible to the tax net.
I see. So when we look at that huge 2.1 trillion figure, how much of that is this invisible commerce?
The estimates in the source are pretty alarming. They suggest that 30 to 40% of all retail digital volume is happening in this gray channel.
Wow. So we could be talking about, what, 700 or 800 billion rupees, maybe more, flowing every year without ever hitting a tax return.
Correct. It creates this massive hole in the bucket. The government is trying to fill the bucket to build roads and schools, but the bottom has fallen out because of how we pay for things now.
Which brings up a big question about intent. Is that vegetable vendor actively trying to cheat the government? Or is something else going on?
And that's the important nuance here. The source argues no, it's not malice.
Okay.
It's rational economic calculation.
Meaning they're just doing what makes the most sense for their own bottom line.
Exactly. Put yourself in the shoes of a small merchant. Think about all the friction involved in doing it the right way.
Right. You have to register for a PAN card, maybe a VAT number.
Which is complicated. You have to keep detailed books. You have to file monthly or quarterly returns. You might even need to hire an accountant because the forms are confusing. It's a huge cost in time and money.
And it's intimidating if you don't know the law.
Totally. Now compare that to the alternative. Printing a QR code from your mobile banking app.
Which takes about 30 seconds.
30 seconds. It's frictionless. It costs nothing. And right now, it has zero consequences.
So the government's own push for digitization has inadvertently made being informally digital the smartest business move.
That's the source's verdict.
Yeah.
You get the modern tool digital payments, but you get to shed the modern obligation taxes.
That is frustratingly logical. Why would I volunteer for that headache if I can operate just as well without it?
You wouldn't, not unless you were forced to. And the IRD, the tax authority, they can't force you if they can't see you.
Let's challenge that for a second, though. The IRD isn't totally helpless, is it? I mean, they have things like the VCTS, the Vehicle and Consignment Tracking System.
They do have tools, but the source says those tools are designed for an analog world, or at least a world of big physical goods.
What do you mean?
VCTS is great for tracking a huge truck full of cement going from a factory to a warehouse. It tracks the physical movement between big companies.
So it catches the big fish?
It catches the big fish moving big boxes. But it's totally blind to digital services. It can't see a freelance graphic designer getting paid. And more importantly, its tracking stops at the warehouse door. It can't see the final retail sale at the market.
What about digital invoicing? I get those from big stores now.
Sure, but again, that only applies to businesses that are already registered. The source calls this taxing the taxed. It makes things more efficient for people already in the system, but it does nothing to catch the millions of transactions happening outside of it.
It really feels like a massive data problem. The banks have the data. The tax man wants the data. Why aren't they just talking to each other?
Silos. They are completely siloed. There's no single source of truth. In Nepal, your PAN card, your tax ID, it isn't systematically linked to every single bank account you open.
Really? I thought they asked for a PAN when you open an account now.
For some accounts, yeah. Corporate ones.
Yeah.
But for personal savings accounts, it's not a universal, mandatory, real-time digital link.
So the IRD would have to manually sift through billions of transactions to find the cheats.
Essentially, yes. They'd have to subpoena the banks, get a massive data dump, and then just guess. It's an impossible task.
A needle in a haystack, and the haystack is growing exponentially.
Exactly.
You know, whenever we talk about digital payments, the conversation always turns to India. Their UPI system is the global benchmark.
It really is. The whole world is studying it.
And when you look at Nepal's system, on the surface, it seems so similar. We scan codes, money moves instantly. Why isn't it working there for tax purposes?
This is where the analysis gets really sharp. The source argues that while the surface looks the same, the app, the QR code, the foundation is totally different. They say Nepal copied the interface, but missed the stack.
The stack, like the technology stack.
Specifically the India stack. It's their digital public infrastructure. Think of it like a 3-layer cake.
Okay.
At the bottom, the base layer, you have Aadhaar, A universal biometric ID for every single person.
Right, our national ID isn't quite there yet.
Not even close.
Ah.
Now, the second layer in India is the bank account. And every bank account is mandatorily linked to that Aadhaar ID.
So the person and the bank are hard linked.
Hard linked. And then the top layer, the PAN, the tax ID, and the goods and services tax network. Those are also hard linked to that bank Aadhaar connection.
Ah, I see where this is going. It's a closed loop.
It's a closed loop. The data is instantly cross-referenceable. The authorities can see a business and say, hey, your tax return says you made 10 lakhs, but your linked bank account shows 50 lakhs in deposits.
The system flags it automatically.
And Nepal doesn't have that connectivity. The source uses this brilliant, kind of harsh metaphor.
Oh.
They say Nepal built the attractive shopfront of UPI, the nice app, the easy scanning, but forgot to build the warehouse and accounting office in the back.
Oof. So that's a sharp critique. We wanted the convenience without the underlying infrastructure.
We inherited the difficulty of formalizing an economy without the data architecture to actually solve it. We got the shiny apps, but the back end is still disconnected.
So if we missed the boat on building an India stack, and I assume that would take decades to build from scratch now, what do? The store seems very clear on a specific solution.
They are. They say, don't try to patch the current system. It's too broken. We need new plumbing. Yeah. And that plumbing is a CBDC.
A central bank digital currency.
Exactly.
Okay, we need to pause and clarify this, because when people hear digital currency, they think of crypto, or they think, I already have digital money in my eSeawell wallet. What is the actual difference?
Great distinction to make. First, a CBDC is not Bitcoin. Bitcoin is decentralized. A CBDC is the opposite. It's controlled entirely by the central bank.
Okay. And how is it different from my e-wallet balance?
When you have money in an e-wallet, that's a liability as a private company. You're trusting that company. A CBDC, let's call it ENPR, is a direct liability of the Nepal Rashtra Bank. It's digital cash with a sovereign guarantee.
So it's safer. Got it. But I'm still stuck on the tax problem. How does changing the type of digital money solve this?
This is the killer feature of a CBDC. It's a single word: programmability.
Programmability. So you can write rules into the money itself.
You can write rules into the money itself. Because the ledger is managed by the central bank, you can design the system to architecturally differentiate between a P2P transfer and a merchant payment.
But wait, isn't that the problem we have now? We can't tell them apart?
In the current system, yes. But with a CBDC, you build that distinction into the protocol. The source proposes what they call automated tax collection.
Okay, walk me through it. I'm at the market buying my spinach. What happens?
You scan the merchant's code. The system recognizes this wallet as a registered vendor. The moment you hit send, it executes a smart contract.
A smart contract.
Think of it as an automated rule. It splits your payment. You pay 100 rupees, the system could send, say, 99 rupees to the vendor.
Then the other one rupee.
It instantly remits that 1 rupee, a tiny transaction tax, directly to the Inland Revenue Department's wallet.
Wow. So it's completely automatic. It happens in the background.
Automated real-time collection. And think about the impact on that merchant. No more filing forms, no hiring accountants, no fear of an audit. Compliance becomes invisible and effortless.
That just changes the entire game. It shifts from, I promise to tell you how much I made later, to the system just takes a tiny slice as it happens.
Exactly. You move from voluntary post facto declaration, which humans are terrible at, to automated real-time collection. And suddenly, that 2 trillion rupee shadow economy is part of the tax base.
It sounds incredibly efficient, almost too efficient. And here's the but. This feels a little Big Brother, doesn't it? The government seeing every single transaction.
You hit the nail on the head. That's one of the hard truths the source acknowledges.
Right.
This isn't magic. It's politically very, very complex.
Privacy is the giant hurdle.
It's the biggest one. I don't want the government knowing exactly where I buy my coffee or how much I spend on dinner. And in a democracy, that matters hugely.
So how would you even design around that?
Well, the source suggests you need robust legal frameworks. Maybe design it to anonymize small P2P transfers, so your personal life stays private, but the tax function would still trigger for wallets tagged as a business. It's a huge design challenge.
And I can't imagine the banks would be thrilled about this either.
No. Resistance from incumbent players is a huge risk. They might see a CBDC as a direct competitor. If you can hold your money directly with the central bank, why do you need a savings account at a private bank?
So this idea has powerful enemies.
It does. But the argument in the source is that we don't really have a choice. They call the current path an existential crisis for the state.
Existential crisis. That sounds a bit dramatic.
But think about the trajectory. The digital economy will keep growing. If the
Mhm.
tax base keeps shrinking because it's all going into this gray zone, what happens?
The government runs out of money.
Exactly. It can't pay for schools, hospitals, roads. So they have two bad choices: cut public services or massively raise taxes on the few businesses that are compliant.
Which is unfair and just pushes more people to go informal.
It's a death spiral.
Yeah.
And a crackdown, sending police to check QR codes, would just drive everyone back to cash.
Which defeats the entire point of modernization.
Right. So the argument is that a CBDC isn't just a nice option, it's the blueprint for the future. It's about building a system where compliance is the default setting, not a choice you have to make.
It's a fascinating shift in perspective. We started this deep dive in an alleyway in Aston Market, and we've ended up talking about the fundamental architecture of the central bank.
It shows just how connected it all is. The tech in our pockets is rewriting the rules of the economy, and the government's rulebook is decades out of date.
So here's a final provocative thought for you listening. The source suggests that without this kind of change, without this new plumbing, the digital revolution is actually a threat to the state's fiscal health.
Which is a scary thought. Innovation becoming a threat.
It is. So, in a world where money is just code, should paying taxes be a conscious act of filling out paperwork? Or should it just be an automated line of code running silently in the background? Is the future of citizenship invisible?
That's the question.
Thanks for listening to this deep dive.